You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mish Shedlock, editor of Mish's Global Economic Trend Analysis. Welcome to the show, Mike.
Hey, a pleasure to be back on.
One of the questions people are asking today is, does Apple really have over $200 billion in cash on hand to play around with?
Well, if you count actual cash, short-term investments, and long-term investments, the technical answer is yes. They've got roughly $203 billion. However, if you subtract liabilities, they don't have nearly as much. And if you factor in taxes they would owe on a lot of this money and investments they're keeping overseas, you need to subtract another $59 billion. So if you do all of that, they actually have quite little cash, although technically they could spend it. So this all came about from a series of articles, one done on Market Watch where a guy did it correctly, and one did it on CNN Money where the guy said, well, he just couldn't figure out why Apple's not spending $203 billion. So I've done these kinds of analysis before, and the last time, though, was in 2013, and at that time I went through the top 50 companies in the S&P, and actually if you subtracted out debt, the net cash was actually negative. So in essence, they could spend it. It's there. They could spend it, but it would wreck their balance sheet to do so. Now, Apple genuinely has cash, net positive cash, but it's parked overseas, and if you subtract debt and add the tax implications, there's nowhere near as much as what people claim.
I guess that's even like the average person. They can say, well, Jim, you're worth $1 million. If you look at, your retirement plan, your house, your car, your collection of hockey cards. But if you cashed all that in, where would you live and what would you drive?
Well, one would also have to factor in a mortgage. So, you can live in a $1 million house and say, and add that to your wealth side of the equation. But if you've got an $800,000 mortgage, you know what? You better be subtracting $800,000 from that. So that's what these analyses fail to do. They're looking at assets like cash, and that would be an asset to a corporation, but a liability to a bank. So I excluded banks from my 2013 analysis because they're the opposite. But you just can't, look at one side of the balance sheet and not the other, and that's what these superficial analysis do.
Are people expecting Apple to suddenly spend all this money to boost the economy? That's a lot of money to throw around.
Well, what they're expecting is Apple to go out and spend it and do something, give dividends, and say, oh, well, if they give all this money away in dividends, okay. If they give all that money away in dividends, then what about the debt on its balance sheet? And to give it away as dividends, they first have to repatriate it. So $181 billion is held overseas, and roughly $59 billion of that would go to the tax man if they had to bring it back. So that cash total would immediately shrink from $180 billion to something more like $120 billion. And if you count long-term debt, you have to take another portion of that unless they want to keep that. So the money's, it's there, but not without most of these corporations would have to wreck their balance sheet to spend it. Apple could spend a little, but not as much as what they say. Meanwhile, here in Chicagoland, I just did a report on $1 million home sales in Chicago suburbs, and it seems people want to cash out. Guess what happens when everyone tries to get out at the same time at prices more than they can get? Well, what happens is either the homes sit there unsold, which is actually what's happening in numerous Chicago suburbs, or the prices have to come down. Right now, these properties are just sitting there. One city, city of Burr Ridge, has 100 homes on the sale for $1 million or over. Only 14 have sold at that price in the last 6 months. So, guess what? They are not going to get their price. What price they get, I don't know, but the longer they wait to try and get their price, unless it comes down, the less likely they are to get it, because there's going to be more people wanting to get the hell out of Illinois, thanks to inane tax decisions in the state of in the city of Chicago and in the state of Illinois in general. We've got a rush of people who would just assume, boomers who would, just assume retire to somewhere warmer, and businesses who don't like Illinois tax policy. All of that is going to weigh on prices. I have to commend RE/MAX agent, and it's very seldom I commend real estate agents, Linda Sirocco, for her assessment. They won't get their price. You don't see that often in this industry, but there it was. I posted some nice charts here. Chicago was one of the cities that actually, some cities recovered, and have a bigger bubble now, mainly in California, some places in Florida. Dallas is beyond its last peak, but home prices never really recovered from the bust in the Chicago area, and Illinois in general, I would assume, and it's Illinois state policies is why.
You never hear anything about the economic crisis in Illinois in the mainstream media. Why is that?
Well, you do see it here in Chicago. You don't see it in other places. If we were, reading LA newspapers, we would see it there. For instance, I found this report on people exiting in Crane's Chicago business. There, might be a similar report in, Crane's New York business or Crane's LA business or whatever. I suspect they have those. But, yeah, that's not exactly mainstream. But, you might see it in the Chicago Tribune. But, yeah, you don't see it on the Financial Times. You're right. You don't see it particularly in the Wall Street. You don't see it in the Wall Street Journal. So, yeah, and these problems are out there. They're very real, and they're simmering. And the pension crisis is widely understood, and you do see stuff on the Illinois pension crisis. But there's huge crises in pension crisis in California and numerous other states as well. So, yeah, in general, they're underreported.
Now, I know people in Canada said they were worried about their pensions, but apparently our government did something about that back in the 90s when they decided to up the contributions you make to the pension plan in Canada, and they've also upped the age that you can collect your pension to 67 from 65, depending on your birth date. So
yeah, that's not happened here in with public pensions, and that is exactly part of the problem. We have fire workers, teachers, police retiring at the age of 55, collecting a full pension. These people are going to collect more pension in retirement than they ever made during their working lives. They get to, thanks to these sweetheart deals. Meanwhile, over in China, let's hop across the Pacific and discuss China's Forex reserves. They've actually been shrinking, and to the tune of almost $500 billion over the last year. And the reason why they're shrinking is China is actually dumping its U.S. treasuries, so to speak, or selling them, if you want a different word. And they're doing it not to get rid of them per se, but to actually prop up the value of the yuan in an effort to stop capital flight. And the interesting thing about this story is, all the people predicted various tsunamis that would happen as soon as China started selling its Forex reserves. And actually the tsunami is right now in China not where these people predicted it. Certainly there was no, inflation in consumer prices in the U.S. as people expected. The buyers of treasuries have driven yields down from 2.8% to they touched under 2, and they're back above it in the last week. But people just don't realize and still don't what all of this debt means and how much of a drag that is going to be on all of these inflation aspects. I'm still in the deflation camp. I think we're going to have another round of asset deflation. When that happens, I don't see the Fed hiking into it, nor do I see inflation in general in prices going up, whether the Fed hikes or not. So people have continually got this story wrong, been predicting high inflation in the U.S. Since the early 2000s, and here it is, 2015, and we don't see it yet. And I don't think we will, because they just don't understand the effect that debt has on all of this. Certainly, we've seen massive asset price inflation again for the second time, and we see that in junk bonds. We see that in real estate. We see that in equity prices, share prices, but we've not seen it in consumer prices. And if there's a bust in equity prices, as I think is going to happen here, then we're going to be in another round of asset deflation, and I just don't see any way you get a high consumer price inflation out of an asset bubble bust. This is not 1970.
We'll have more with Mish Shedlock right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mish Shedlock. Mike, what do you think is going to happen with the price of crude oil? It seems to me the romance with the gas guzzler is back on. People are buying RVs and SUVs like crazy.
Tough question. I actually don't have a call on that. It's possible we've seen a bottom or a short-term bottom here in oil prices. They're seeming to be pretty stubborn here in the mid-40s. I think they touched all the way down to the high 30s a bit back ago. Whether or not and how fast they rise is going to depend actually on all kinds of demand. And if we see this asset bubble bust or recession, then demand by definition is going to be falling. That doesn't necessarily mean prices go down further. There's still supply issues here. Prices are so low that the oil production and a lot of the oil production in the U.S. via fracking and other things that we're doing is not even economically justifiable here at the price of gas we've seen. So we're going to have a junk bond bust here. And in fact, we've seen a bit of it already, especially in the oil sector. So, one doesn't know, and then it would depend on how strong a recession or how big a slowdown here, in the United States. But let's just say that there's not a lot of catalyst here, I don't think, for oil heading back up to over $100, and it's gotten there, twice in recent memory, right? 2007 and got to 2008, it got to over 140. During the recovery, bounced back over well over 100. Are we going to go back up there again anytime soon? I would think not, but certainly there's room here for oil prices to rise, depending on various supply issues and how big the next bust is.
Ben Bernanke, the former chair of the Fed, has a new book out. Of course, he's probably bragging about all the good things he did. Did he do good things, or is he just trying to sell a book?
He's a guy that cannot self-assess. We've all made a number of calls. I pointed out some of my bad ones in a recent blog. I've also made a number of really good calls. I don't see anything that Bernanke has done or the Fed has done that's any good. You don't come out and brag about saving the world when you were the one that put it on the brink of disaster. We had a huge asset bubble in 2000 with the dot-com boom and bust, and we had a housing bubble in the early to late 2000s, and the Fed is essentially whitewashing itself of those problems, and it created it. It especially created, the housing boom, not just in the United States, but globally. And the emerging markets are blowing up now. Well, why is that? That's because, one can point to China for that one. China kept rates, so low, and demand, it grew its economy on the base of a property bust, and of building malls where no one shopped, building entire cities where no one lived. That created an enormous demand for concrete, for steel, for copper, for all kinds of commodities. What did it do? It induced an artificial boom in places like Brazil, Australia, Canada, in terms of natural resources. And now we're on the bust side of that. So, the Canadian dollar that everyone, thought was going to go to the moon versus the U.S. dollar is now back well under parity. Same thing in Australia, and China itself looks actually sick. So, it's easy to come out and say, look, I did all of these great things, but hey, let's look at some of the ramifications. Let's look at who caused the property bubble, and let's look at some of the emerging market ramifications right now. Let's look at the bust that's going on in China, and let's point the finger where it blames. That's at central bankers in general and the Fed specifically. Ben Bernanke.
I saw a little bit of an interview with him. He said, the reason I didn't tell you about the economic crisis back in 2007 was my job was to keep people from panicking.
Look, this guy had no more clue that a crisis was coming than my grandmother can play basketball for the Chicago Bulls. That's what we're talking about here. It's clear that this guy, when you look at interviews, was just absolutely freaking dead wrong. You're going back to interviews in 2005, 2006. This guy absolutely did not see the housing bubble, no question about it. So, if he's making that claim, I'll flat out call him a liar. Not only is this guy stupid, he's a liar.
Mish, thanks a lot for being so honest with us.
My pleasure, and I love being honest about Bernanke. So, pleasure to be on.
My guest has been Mish Shedlock, editor of Mish's Global Economic Trend Analysis. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.